Good afternoon. I'm excited to speak with you today on this topic of charitable trusts and the decade ahead. What advisors need to know, what planned giving specialists need to know, what donors and clients need to know. So I'm Paul Casperson. I oversee the Office of Estate and Gift Planning at the University of Florida. I've been here for since the beginning of 2013. And that's my day job. I love what I do. On average, our department will help produce 1 to 2 charitable remainder trusts a month. And we might do maybe another 4 to 5 charitable lead trusts on an annual basis. And those are trusts, I want to be clear, those are just the trusts where we from A to Z sit down with the donor, and most of the time they're advisors as well. And we're kind of the lead in walking the donors through the process. We have, of course, many donors who do charitable trusts outside of working with us and simply name us as beneficiaries, and that works great too. I also am a national board member of NAPEC, the National Association for Estate Planning Councils, and really enjoy the opportunity to go out and speak with estate planning councils throughout the country and hopefully evangelize for that great organization. And then finally, on nights and weekends, I'm the founder of Plan Giving Interactive, and that is a software platform that does primarily 2 different things. One is it's a high-end plan giving, a charitable giving research tool and resource that you can create proposals for donors and for clients. And then, of course, there's another section of it called Gift Docs. And Gift Docs is a section where you can draft all kinds of various documents, gift agreements, and specifically testamentary charitable remainder trusts, which we're going to delve into as one of the key topics in our hour today. So with that, today's agenda, the ultimate goal is really to help every one of you, if you're a professional advisor, create some business for yourself by helping your clients do good, maybe in ways that they didn't even believe was possible for them. In my experience, charitable trust, charitable remainder trust, charitable lead trusts are still one of the rare ways I know that seems to astonish donors when they become educated about the advantage of these qualified trusts when they are qualified. And with just a little bit of charitable intent sometimes, that can really put a client or donor over the edge to creating a beautiful charitable trust. Maybe you never even saw this client being that philanthropic or having the financial means to be able to do so, but by using a charitable trust, it allows them to be able to do more, like I said, than they ever even imagined. So for today's agenda, I'd like to just discuss the basics of the private foundation rules, which are important because they apply generally to charitable remainder trusts and charitable lead trusts. So that's important. And then we will delve into the basic primer of charitable remainder trusts. I want to zoom in then on the Secure Act, the Tax Act of at the end of 2019, which changed the way that we leave behind retirement assets to loved ones. And so I'll get into more of that, and a great tool that maybe is a substitute for still maintaining the stretch is a testamentary CRT. I want to talk not just about the reasons why, because there's a lot of articles that have already been published about that and presentations that have been delivered. I want to talk about the practical application. When the rubber meets the road and you've got a client or a donor that says, yeah, I'm in. I love this idea of a testamentary CRT to leave my retirement assets for income for my kids' remainder to charity. How do I do it? So we're going to talk, we're going to cover as much of that ground as we can today. And then as we round out, we will cover grantor lead trusts and non-grantor charitable lead trusts. We'll probably be able to scratch the surface with those. And then if you have questions or just, if you have questions for me, this is a pre-recorded webinar for another presentation that I'm going to be delivering in person. So feel free to reach out to me by phone or by email if you have any questions following today. So with that, I want to talk first about the Tax Act of 1969. So to understand the private foundation rules, it's really important to understand where, our history as to why things are where they are today. So it was the Tax Reform Act of 1969 that provided the legal framework for what we know today, as charitable remainder trusts, charitable lead trusts, private foundations, even donor advised funds. And this came about to reform abuses of loosely regulated charitable trusts. There were charitable trusts long before the Act of 1969, but it was very, there wasn't a lot of guidance from the IRS in terms of what was acceptable and not acceptable in the charitable world. So now, after 1969, private foundations were then compelled to make much larger distributions than they had been doing. And these changes and others in the law had a powerful impact on the practice of charitable gift planning. So that's where all of these things came to pass. Charitable remainder trust, pooled income funds, which are a distant cousin to charitable remainder trusts, and charitable lead trusts. There's also other split interest gifts. Technically, a retained life estate wasn't necessarily part of the Act of 1969, but that's kind of in this family of split interest gifts that are acceptable by IRS standards, because most of the time, if you don't give the entire interest in an asset, you're not going to be able to get a deduction for it. And so there are exceptions to that. And most of the exceptions that you see are on this slide deck right here. I don't have time to go into all of them. I think most of you know what an undivided portion of real property would be, or a conservation easement, but those are all of the essentially the split interest gifts. So if you are not in the practice of structuring charitable entities or restructuring charitable entities, you probably don't need to delve too far into this, only to know that when you use the term 501c3, you're technically talking about public charities. And under this umbrella of public charities, you can see it gets very complex because you have these things called supporting organizations. And again, if you're not in the business of establishing charitable entities, you don't need to concern yourself too much, but they're essentially a good kind of go between what a public charity is and a private foundation. So it's almost a subsidiary, if you will, of public charities. There are three different types of supporting organizations. Again, it's beyond the scope of today's conversation. Each of them serve different purposes, but unlike private foundations or supporting organizations, which are technically separate, a donor advised fund is considered a public charity. And I bring that up because most of you in the advisor community are clearly familiar with donor advised funds and the meteoric rise of donor advised funds. But really what a donor advised fund is it's a separate fund at a public charity. And that public charity is considered a sponsoring organization in which a donor or someone appointed by the donor has kind of an advisory but non-binding privilege over making recommendations or recommended grants to various charities. So the tax filing is similar, though, between public charities and private foundations. They both have to complete 990s. The private foundation one is a little bit different, but the Act of 1969, I bring up this slide because it did a lot of things, but it also helped to define what is a private foundation and what is a private foundation for income tax purposes, what is a public charity for tax purposes. And more importantly, it helped to actually create and fortify how donor advised funds work today. So a decade or two after 1969, by then most financial services institutions were out gaining private letter rulings to go out and create their own public charity so that they could offer donor advised funds to their clientele. To set up private foundations, there are many rules that are well known that need to be addressed when you set up a private foundation, and that is true for charitable trusts. And so that's why, again, this is part of this whole primer. So first and foremost, self-dealing. Now, if any of you are planning to go to the Heckerling, I just looked at their agenda for the winter of 2022. And in the charitable planning section, not one, but two of the presentations, the title of them address addressing self-dealing in private foundations. So clearly this must be even more of an issue than what I give it credit for, but a private foundation is constrained from financial transactions with people who are considered to be disqualified persons. So, an example of that would be, the patriarch and matriarch donate an asset to their private family foundation, and one of their kids or grandkids purchases that asset from the foundation. Even if it was fair market value, a transaction like that would be prohibited. You've got the minimum distribution requirement, 4942. So most of you know that private foundations are required to distribute 5% to charitable organizations. Excess business holdings. This is where a private foundation and its disqualified persons may own no more than 20% of a business enterprise, voting or ownership interest. And so that would include partnerships, joint ventures, and other unincorporated enterprises as well. 4944, private foundation managers. This is just a good prudence. This is similar to fiduciary rules as it relates to trust management. Taxable expenditures. This happens, on the rare occasion where a private foundation makes distributions for political contributions or things like that, where they're using resources from their foundation for lobbying and other things, and other types of political interventions. And then finally, you've got your excise tax on investment income. Other one that it's not up here, but it happens as often as self-dealing to be concerned about is unrelated business income tax. And so that's an issue for public charities, but private foundations are also subject to the tax on UBIT. And some passive income is exempt from this, but that does not apply to debt financed income generated by assets or activities that are unrelated to the organization's exempt purpose. So if you put real estate that had a mortgage on it, for instance, into a private foundation, that could be considered, that could trigger unrelated business income tax, probably among other things. Another part of the primer before we delve into CRTs is the IRS 7520 rate. So again, most of you are familiar with this in the world of estate planning because you deal with this on a lot of non-charitable types of issues like grants and those types of things. But the Treasury publishes this rate when valuing an annuity, the interest for life for a term of years, and a remainder interest. And these rates are calculated from the applicable federal rate published by the Treasury, the 7520 rate. For charitable contributions, it's possible to utilize the rate for the current month, which I believe this month of September of 2021 is 1%. But you can also use the rate for the previous 2 months, whatever is optimal for you in that situation. And so for those of you who are unfamiliar with how the 75/20 rate works. We will be able to maybe put a finer point on that as we talk a little bit more, whether it has to do with the charitable remainder trust or even an opportunity to talk about charitable lead trusts. So these trusts are split interest trusts. And so that's why the 75/20 rate is there, because the IRS is suggesting, okay, the 75/20 rate is basically the 10-year treasury. It's pretty much the same rate, 1% currently. So what they're suggesting is that when you set up a charitable remainder trust, you're transferring your wealth, and there's an income interest and a remainder interest. And a lot of your tax benefits, your income tax deduction, is going to depend on the 75/20 rate. It's going to depend on what the IRS deems to be the investment performance of those assets while they're in the trust. And so that's what the 75/20 rate determines. It's really an assumption. This can be really good for split interest trusts, or it could be prohibitive in some cases for split interest trusts. But let's talk a little bit about just the basic elements of a charitable remainder trust. And I'm going to use the word qualified because, again, the Tax Act of 1969 is really what helped to define what a qualified charitable remainder trust is, and the favorable tax treatment that comes along with the use of a new unit trust or annuity trust. So the minimum payment has to be 5%, and there's a 4-tier system for recognizing taxable income. So when you put an asset into the charitable remainder trust, assuming it's qualified, you put the asset into the CRT, it's tax exempt. So it's able to sell the asset tax-free, and you still have 100% of the proceeds invested in the trust to be able to provide trust income. Most of the time, it goes back to the person, the grantor of the trust, the donor, but it could go to the donor's children. That's very, very possible. And then that could be paid to the beneficiaries either for their lifetime, or if the donor does not want to do a lifetime, they can do a term of years, but that term of years cannot exceed 20 years. At the end of the trust term, either at the demise of the income beneficiaries, or if it's set up for a specific terms of years, then the remaining principal goes to one or more public charities. Well, it could be public charity or it could be a private foundation. Both of them are acceptable. And so that's how the basics of a qualified charitable remainder trust works. It's an irrevocable trust, and you can fund it with a variety of assets, whether those are capital assets like real estate or publicly traded stock or closely held stock, or you can even put in ordinary income assets such as inventory. I funded CRTs with thousands of acres of corn and soybeans in my days at Iowa State University. Or it could be funded with other types of ordinary income assets, such as depreciated equipment. Again, in my days at Iowa State, funded farm equipment, agricultural equipment, tractors, combines, and so on. Actually funded a CRT with those types of assets. So it is a Swiss Army knife. You can do a lot of different things with a CRT. In order to also be a qualified CRT, there's really two payment structures. And many of you are familiar with these acronyms, the CRAT and the CRUT. So they can either be established as an annuity interest, or it can be established as a unit trust. So the main difference is that when it's CRAT, using easy rounded numbers, if it's a 5% CRAT and it's funded with $1 million in cash, then it's going to pay $50,000 to the income beneficiary for the term of the trust, and that number is not going to change. It's fixed. Now the trust could eventually exhaust itself. It could run out of money before the end of the trust term. I have been close to witnessing that happen. I have never seen it happen actually before. It's a bummer for the charitable organization because they don't receive anything. It's certainly a bummer for the income beneficiaries if they lose their income. But there is that risk, and it's different from a charitable gift annuity in that instance, which we're not going to be talking about today, but just something that I think it's important to address. Charitable remainder unit trusts are more popular for a variety of reasons. One is they're easier to provide the income, especially when we have very low 75/20 rates like we have today. But people also like it because the unit trust would pay out, in my earlier example of $1 million now charitable remainder unit trust paying 5%. It's not $50,000 a year flat and fixed. It's 5% of the value of the trust as of December 31 in every year of the trust term. So it gets revalued. And if the trust appreciates to 1.1 million, then the income for that year would be 5% of 1.1 million. If it goes down to 900,000, then it's 5% of 900,000. But over the course of time, the income beneficiary receives somewhat of a reliable income, and there's much more likelihood that there's going to be a solid remainder left to go to charity at the end. Now, I want to walk through something that's referred to as a flip charitable remainder trust. And I bring this up because in almost every case, if you're not funding a CRT with either publicly traded stock or cash, and there are a mountain of other assets that you can fund a CRT with, if you are funding it with anything other than cash or publicly traded securities, you really must set up that CRT as a flip CRT. So this legislation was not introduced in 1969, but rather actually 1997, that this became an add-on to Internal Revenue Code 664, which basically is kind of everything, all things Internal Revenue Code CRT. But the reason that it came about is that before 1997, if you were funding a CRT with an illiquid asset, you really couldn't set it up as a standard CRT because you had no idea when the asset was going to get liquidated by the trust, and how much it would get how much it would sell for. So at that time, they were setting up what's referred to as net income charitable remainder trust, charitable remainder unit trust typically. And that was fine for people back then because interest rates were much higher. So after the asset sold, they were getting the net income of all the investments. And, you know, during the 80s and 90s, or in the 70s, you know, people were getting very good rates from their CRTs, but that diminished over time. And we've had low interest rates really for the last couple of decades since then. So the popularity of the flip CRT came to rise because how a flip CRT works, and I'm going to walk you through the flow chart here. I stress the importance of a flip CRT really for the audience for a couple reasons. It's for donor expectation, because a lot of donors just think that they can fund a charitable remainder trust with an illiquid asset, for instance, real estate. And you know, the next day they're going to start earning 5% income, and it doesn't work that way. The trustee of the charitable remainder trust has to go out and sell this property successfully, just like the grantor would have to outside of the CRT. So that really doesn't make any difference, but it's the perception that we need to make sure that we manage the perception of what a CRT is and what it isn't. And in many cases, the financial advisor expectations, because many financial advisors are familiar with with a wealth replacement trust, which is been a very popularized tool over the years, where they may talk to a client about taking an asset, transferring it to a CRT, and the remainder goes to charity. Your children are not going to inherit that asset then. So what do? You take the income from the CRT, assuming that you don't need it, and you purchase life insurance, and you leave the life insurance tax-free to your kids. It works great, but there's two things that need to happen there. If it's going to be funded with an illiquid asset, you have to remember that it may take several years before that trust is producing any income to pay the premiums. And then, not that it's part of this conversation, but you have to make sure that your donors or your clients actually are insurable as well for that whole thing to work. But step one is recognizing that if you're funding it with an illiquid asset, you may not have the income for a period of years. So let's just walk through how this works. So let's say that I'm funding this with real estate. It could be any illiquid asset other than cash or marketable securities. And so generally speaking, the first thing I probably want to do is I can fund it. I can fund that asset in a CRT, but a lot of people prefer to get an appraisal done before they put that asset into the CRT, just to kind of know what kind of value that they're dealing with. You can do it either way. In fact, you can wait to obtain an appraisal until April 15th of the following year that you make the gift, or whenever you file your taxes for that year. So that's the first step. The second step is, in my example here, is that the donor, again, they can fund that asset in the CRT and they're going to get net income. Okay, so it's a flip net income CRT. So if this real estate is just vacant land and it doesn't produce any income, their income is going to be this. It's going to be zero until the property sells or it flips. So a flip, defined by the IRS, there's about 8 or 9 different triggers that cause a flip net income charitable remainder trust to actually flip. It could be that your income beneficiary reaches a certain age. It could be that an illiquid asset sells. That's probably the most popular one. And in my case here, that's what the flip trigger is when that asset sells. And in my example, it sells in 2023. And let's say that it only sells for $950,000. Maybe it appraised for $1 million, but let's say after expenses and everything, closing costs, what have you, you're dealing with $950,000. So in 2023, in 2022, we sell the asset, and then on January 1 of the following year, so that would be 2023, is when the trust will flip. And then at that point in time, it'll convert to a standard CRT, paying 5% to the income beneficiaries. And then each year going forward, it's going to be based on the December 31 value of those trust assets. And then just again, now we're dealing with the standard trust. At the end of the trust term, the remainder goes to either one charitable organization or to several. So now that I've given you a little primer on CRTs, let's pivot a little bit and talk about the Secure Act. For financial advisors and for many tax advisors out there, you're very familiar with this and how it affects retirement assets, because until the enactment of the Secure Act, it was pretty easy for a beneficiary who inherited a retirement account to receive distributions. If they wanted to take the minimum distribution, they could essentially stretch it out over their lifetime, or at least up until probably they reached 83, 84. And so it was a very, very good opportunity for those who wanted to defer all of the taxation that they have to deal with in inheriting an IRA from a loved one. It was a great opportunity for them to be able to defer that. So the Secure Act, as you know, changed all of that. There are still a few exceptions for eligible designated beneficiaries. I've got the 5 of them listed, or 4 or 5 of them listed up here for those individuals who can still stretch over their lifetime. But generally speaking, for most kids, where most people are leaving their retirement plans to kids, they have to take all of the distributions out of the IRA within 10 years. So what you're going to find with most of your beneficiaries is they're either going to take all the money out right away. They're not going to care about the taxes, which is, of course, obviously the worst outcome. And many of them are probably going to defer it until that 10th year and then take it all at once. And that could be a little better of an outcome, but it's all of the taxes in 1 year. And let's face it, for the majority of these people, mom and dad may be on average 25, 30 years older than you. So they pass away in their mid 80s on average. And by the time you take the distributions, you're probably 55, 60 years old. You're at your peak income and earning years on average for most people. And then you take this lump sum and you stack it on top of those peak earning years. Most of that income can be in the highest tax brackets. And if you live in a state with income tax, I don't currently, but it just kind of piles up the potential income taxes, maybe as much as in some states, 60 or 65% of the IRA could go to federal and state income taxes. So the ultimate question is, can a charitable remainder trust get a lifetime comparable stretch out to what we used to call a stretch IRA? And the answer is it definitely can. It can help absorb the economic loss of what taking away the stretch is. And, the Secure Act, essentially eliminated the stretch, like I said, for most of us. But by naming a tax-exempt charitable remainder trust as the beneficiary of a retirement account, you can talk to your client and maybe give them the option. Would you want to leave your IRA directly to your kids? And do you want them to pay the taxes and maybe, they will get 2/3, if they're lucky, they'll get 2/3 of the IRA? Or would you like to pay them 5 to 6% on all of your retirement assets without paying any taxes, if you're willing to leave some of it to charity? And for those who have charitable intent, I promise you that their ears will perk up and they will listen to you. Even those who have very little charitable intent would probably be open to exploring the benefits of doing so. So how does this flow chart look in comparison to some of our other flow charts on CRTs? So first and foremost, and sorry for the if you can't see all the text in the flow chart here, but how the testamentary CRT works is you've got the owners of the IRA, and in my diagram, I refer to this, or I insinuate that there are 2 people that own an IRA. I know that 2 people cannot own an IRA at the same time, but typically the plan works where the one spouse will name their other spouse as the primary beneficiary of their retirement assets, and the other spouse will do the exact same thing, name each other as primary beneficiaries, and then the contingent beneficiary is going to be this testamentary charitable remainder trust. So you could set up a testamentary CRT for both the husband and for the wife in my example here, and they would have them as contingent beneficiaries, not knowing which would be the first spouse to pass away. So for donors who wish to provide for charity with an estate gift and establish a reliable income stream for one or more of their heirs, using a retirement plan assets can be a very effective way to accomplish both of these goals. There's been a series of private letter rulings that determine that this this type of transfer would not trigger federal income tax on the balance. In fact, the only way that it would is if the trust had any unrelated business income tax. And for most people, their assets in their IRAs and 401ks are not going to trigger any unrelated business income tax. So essentially how it works is on the second spouse, whichever one passes away, their primary beneficiary is going to be their testamentary CRT. So they leave that IRA to a qualified CRT at the second spouse to pass's death, and the assets go into a CRT. The distribution to the trust beneficiary, maybe they have one daughter, and it pays out for her life expectancy, or it pays out for her life, excuse me. And then at her passing, whatever's left in the trust passes to a charitable organization tax-free. Recall that the only type of organization that can avoid income taxes on retirement assets, income in respect of a decedent, is going to be a tax-exempt organization like a public charity. And so while I mentioned the 4-tier system of CRTs earlier, and that's generally considered to be worst first. So you pay the worst income tax first, and that's going to be ordinary income. Well, the bulk, all of the IRA is going to be ordinary income. And so the income beneficiary will pay ordinary income, but at least it'll only be a small amount each year. It won't be the full lump sum distribution of a large retirement plan all in 1 year. It also accomplishes the goal of trust management, where many individuals have left their trusts in the past to non-charitable trusts, and that can be done through what we refer to in estate planning as see-through trusts. And it's a little bit beyond the scope of our talk for today, but let's just say that both of the see-through trust options, which can be used, one is a conduit trust, which just means that in the past, you would take the distribution each year from the IRA and you would give it to the income beneficiaries. Well, that doesn't work anymore, because now there is no required minimum distribution until that 10th year. So if you had a son that you didn't want to leave $1 million IRA to, that kind of planning isn't going to work anymore, because in that 10th year, it's not going to pay him any income each year. And then in the 10th year, it's just going to make a full distribution to him. He may be a spendthrift, and that may be not what you want to do. The other option is what's referred to as an accumulation trust. So the trustee can, hence the name, accumulate the distributions from the IRA. But most of you on the call know that trusts have a much higher income tax rate than regular individuals. So you can do that, but you're going to be paying a significant amount more of income taxes than you probably had anticipated. So a great solution in between both of those, in my opinion, is to establish a testamentary charitable remainder trust that can provide a lifetime of income to the beneficiaries. The beneficiaries are going to pay the taxes at a lower tax bracket than probably what that accumulation trust would. And furthermore, if any of your income beneficiaries are spendthrift, and maybe you just want them to receive income over their lifetime, then this tool will absolutely accomplish that. And you won't have to leave, you can leave behind 100% of your assets in retirement assets, all to go into this trust for immediate investment, instead of having the beneficiaries have to pay all the taxes in that year of distribution and then reinvest the money. So a lot of the presentations that I've seen so far on this topic talk about the efficacy, and it's really comparing the economics of whether or not you do a charitable remainder trust or whether you skip the charitable trust, and what does it look like if the beneficiary delays the distribution for 10 years, assuming that they're going to do that, and what are the economics. And and that's fine. That's important for financial advisors and other professional advisors to look at. But ultimately, it really comes down more to the application and how you set up these testamentary CRTs. I think that's a conversation where we can add a little bit more value than previous papers and presentations that I've sat in on this very topic. But I do want to touch on it because there's been a lot of great advisors who've crunched the numbers on it. Generally speaking, what you tend to see, and I'll share a little bit of this in the next slide, is that it really depends on two different factors, whether or not there's going to be a strong economic case to make for a testamentary CRT, as opposed to just skipping it altogether. And it depends on how long you expect the income beneficiaries to live, and then what are going to be their tax rates, especially if they're taking a one-time distribution. What kind of tax bracket are they going to be in? They could be in the 39% tax bracket by 2022. Just looking at the proposal that just came out of the House Ways and Means Committee, plus their state income tax. So those are the primary factors, but it generally intersects in about that in the 28th year. So if you really want to say, okay, it actually might be a better result to use a testamentary CRT, meaning that your loved ones could actually end up getting more by giving away money to charity, which is counterintuitive. It's usually about that 28th year if you use basic assumptions. So if you expect, like if the income beneficiaries are in their 40s or 50s, you can anticipate that that there could be a good outcome from an economic standpoint. If you have donors that have even some charitable intent, even a trust that you expect to last 15 or 20 years could still be good. Particularly if you have a donor who wants to leave everything to a trust, and they're looking at using one of those see-through trusts that I mentioned before, which are not good outcomes anymore, typically. But also a testamentary CRT, in order to be a qualified charitable remainder trust, the only thing you need to do is just from an actuarial standpoint, the trust, when you do the initial calculation, 10% of the actuarial present value of the remainder interest. So you have $1 million IRA and you are crunching the numbers to determine, how much is divided between the income beneficiaries and the remainder beneficiary, which is charity. And all that needs to go to charity in order for it to be qualified is 10%. So you're able to keep $1 million sheltered tax-free in this IRA and pay 5-6% to your kids over their lifetime. And all you got to be willing to trade for that is 10% of the trust value. So you don't know exactly how much is going to end up going to charity. It could be more than 10% or less than that. But that's essentially all that you need to. You need to be 10% philanthropic with your retirement assets in order to really make something like this work. And so even for moderate donor intent, and you expect the beneficiaries to live maybe no more than 20 years, maybe they're older beneficiaries in their 70s, then it could still very much work. So going on to the next slide here, this will give you a little bit more. I've got a spreadsheet that crunches some of these numbers that we've created proprietary here. And so using some basic assumptions, let's just assume that the income beneficiary, or the beneficiary of the IRA, they're going to be in the 37% tax bracket on that lump sum withdrawal. And let's say that over time, they were going to pay 22% tax, just generally speaking, on the income from those assets. And let's say that in scenario one, you've got an individual that inherits an IRA, $500,000, and they just make an immediate withdrawal, and they invest the money, which if somebody takes all the money out in that year, in my experience, they probably don't have the discipline to go and put it into an investment account. They probably have some spending desires. So that's probably going to be the most ineffective scenario there. Probably the most effective scenario without any charitable intent whatsoever is scenario 2, which is, again, individual inherits the $500,000 and they just let it invest using the basic assumptions here of 7%. And they just let that continue to percolate for 10 years, and then they make their distribution. Yes, they pay a lot in taxes that year based on that 37%, but it's still certainly better than option 1. And then option 3, I put a dotted line there so you could really see what the difference is here, and how you could leave so much more to charity, and your clients can make a charitable impact without really sacrificing much for their loved ones. Now, again, this is for a longer term trust. I put it out there for 35 years, but for anyone in their 40s, and if it's a son and a daughter, both in their 40s, it's probably likely that trust will last for 35 years, that at least one of them could live for that long. And so in that scenario, not quite as much income goes to the income beneficiaries as option 2, but look at the amount that goes to charity. You have a total benefit of $3.5 million versus, probably 2.7 million that goes to the loved ones. So that's really powerful information that you can share, I think, with clients and with donors. Just a basic example here, Agnes, she has that $1 million IRA, and you put it this way, Agnes, what would you want? Would you want, your loved ones, your son and daughter here, to inherit $600,000 after taxes from your $1 million IRA? Or would you want them to divide 5%, maybe 6% off of the entire $1 million and keep that working in a charitable trust, and then whatever's left, go to the charity of your choice? Would you be interested in that? And hopefully that's something that Agnes would happily consider. So now, where does the rubber meet the road here? I think where there's a lot of questions that are still lingering out there, if you haven't put a lot of this into practice yet, is I have a friend of mine, Tim Prosser, in the industry, plan giving attorney. He published an article a month or so ago, Where Should a Testamentary CRT Document Live? It's a great article, and it's a good starting point to this conversation about the application of actually setting up a testamentary CRT. Here's the main concern that I have with it, just in my observations so far. The legal cost to setting up a testamentary CRT needs to be low, and it needs to be much lower than the legal cost of funding a current CRT. And I can understand, why setting up a CRT might run between $2,000 to $3,000 depending on the complexities. But the problem with testamentary CRTs is you've got an individual who may have $1 million in their retirement asset. Maybe they have a total net worth of $3 million. And you're suggesting to them a great solution, and they love it. They say, where do I sign up? You say, okay, you need to sit down with your estate planning attorney and really go through these nuances. And that's fine. Everybody should do that. I'm not saying that they shouldn't. But attorneys and other advisors really need to find ways to streamline the creation of these types of trusts, because somebody is not going to pay $4,000 to $5,000 or maybe even $2,000 to $3,000 to set up something that's going to be beneficial when they die. And who knows if the legislation will change again, where the stretch comes back in a few years. So I doubt that it will, but we don't want the cost to be so prohibitive that people won't take advantage of this great opportunity. So my company, as I mentioned earlier, Plan Giving Interactive, we have a membership to a tool called GiftDocs, and GiftDocs does a number of different things, but for $200 a year, which is a great value, you have access to developing testamentary CRTs for your clients. And for plan giving officers, you have an opportunity to draft them at least, but still absolutely encourage your donors to review all of this with their professional advisors before they actually put it in place. So how do you put it in place? Well, first and foremost, what a lot of the experts out there believe is probably the most effective way to do this. First of all, the IRS published many years ago their specimen documents related to CRTs, and they did that for lead trusts as well. And so the general idea is that if you follow those documents, you're going to be safe. But the problem is that none of those documents fit perfectly for what we're trying to do here, which is to create a testamentary CRT funded with retirement assets. The specimen documents the IRS produced for testamentary CRTs are set up to be incorporated into a last will and testament or a revocable living trust. And that's okay. You can do that. You can see that on my slide here. Many people could do that with retirement assets, but a lot of advisors feel that that is not the most effective way to do it, and in fact could cause some unintended income tax consequences from the IRA. The better thing to do is to name the IRA, name the trust, the testamentary CRT, the beneficiary of the IRA directly. So, and that's easy. That's an easy conversation to have. But the only challenge with that is that if you don't fund that CRT during your lifetime, and I've had a few donors do that, they've funded a CRT and then it's an active CRT. So they file the taxes on it each year. It's paying income to the beneficiaries, maybe to their kids or to their spouse. And then when they die, their IRA is going to go into that CRT. So it's not a testamentary CRT, it's an existing CRT. So the challenge is if you don't fund it during your lifetime, you have a dry trust. So what you really need to do is, if you live in a state that has really a lot of prohibitions with dry trust, you need to draft it as a revocable trust. And you might fund it with a nominal amount, and you make it revocable and then irrevocable at the death of the grantor. So there's no intent to actually invest, the $10 nominal deposit that you make in the trust, and you don't have to make payments or file tax returns or anything until the death of the grantor, when the real money will come in, which would generally be funded with be funded with IRD assets of some kind. Most of the time, probably IRAs. But you could also create a qualified CRT today. There's nothing wrong with that. Again, as I said, I've had donors that have actually done that. That simplifies the process. So it's an irrevocable active CRT today, and then you don't have to worry about the nuances of making it revocable today and irrevocable during their at their demise. The reality is that most of your clients don't want to take $100,000 or $200,000 and fund a CRT today for that income beneficiary. They'd rather just do it at their passing. And so you do need a tool that will help you to develop this in a very rapid pace. If you're spending a lot of billable hours on this, and again, if you're going to quote somebody $4,000 to $5,000 to set one of these up, they're probably not going to do it. So that's where I'm hoping that GiftDocs will be able to help attorneys and other types of professional advisors and plan giving officers to be able to really kick these opportunities into high gear. And this is just the Treasury reg that kind of cites, why many of the pundits out there recommend that you retain the right to revoke actually in the CRT document, which is definitely counterintuitive. But this ensures that the trust is not a qualified CRT until the grantor's passing. So testamentary CRT checklist. For you advisors out there, there are just several things to consider. Choosing a trustee. The University of Florida serves as trustee of many charitable remainder trusts, and I know that many charitable organizations do, but there are also a lot of great banks and other trust companies that can do that job. Then, choosing what type of CRT. Most individuals are going to do a basic charitable remainder unit trust. I walked you through a flip CRT earlier, only just to give you a primer on CRTs, but it is certainly possible to actually set up a flip CRT that's testamentary. So for instance, maybe you don't want the income beneficiary to start receiving income until age 65. You can absolutely do that with a flip provision in a CRT, but most of the testamentary CRTs are going to be a standard charitable remainder unit trust. You also want to make sure that when the trust is funded, that in order to be qualified, when you run the calculation, 10% of the actuarial present value of the remainder interest must go to charity. That means today that, maybe a 30-year-old or someone in their late 20s, you could pay that out income for their lifetime. But if you're talking about two kids, like two grandkids, they probably need to be in their mid to late 30s in order for that to pass that 10% test. So that's just something that you need to be cognizant of. And then just a general warning from the pundits that are out there is that you never want to set up a gift to charity using retirement assets as a pecuniary bequest, whether that's a direct bequest from a retirement asset or if it's to fund a CRT, because when you do such a thing, when you the funding date of the distribution, the property will be considered a sale of the estate for income tax purposes. So it would cause immediate taxation. So you want to do a percentage of the IRA. Obviously, in an ideal situation, you'd leave 100% of the IRA to a charitable remainder trust. In theory, you could leave half of the of your IRA to your son, who manages money well, and you could leave the other half to your other son who doesn't manage money well to a testamentary CRT. You could do it that way as well, but it should be a percentage. I didn't leave much time for charitable lead trusts. I'll probably have another discussion on that, and maybe we'll bring in other thought leaders in the field to talk a little bit more about charitable lead trusts in the future. But just know that they are very popular today, and they can be set up in two different ways. They can be set up as a grantor lead trust, and these are often done for donors who are looking for immediate income tax benefits and deductions, but they want the chance to get the remainder of this trust to come back to them at the end of the trust. So hence the name. It's really just the inverse of a charitable remainder trust. A charitable lead trust pays the charity first, and then the remainder either goes back to the grantor, typically in a grantor charitable lead trust, or if you have somebody who wants to, who has perhaps concerns about a taxable estate, they want to leave more assets to their kids outside of their gross estate, they can set up a non-grantor charitable lead trust that again pays income to charity, and then the remainder goes to either their children, many, in some cases, more rare, to their grandchildren, but can pass outside of their gross estate in doing so. These are great wealth transfer opportunities. Finally, in every gift that's out there, I always like to think that there's a 5-step process for analyzing every charitable gift out there. These are the facts that you really need to know before you start analyzing. Who's the donor? Is it an individual? Is it going to be a foundation, corporation? In our case today, for our topic, it's mostly going to be individuals. What type of asset is it? Is it a capital asset? Is it ordinary income asset? Is it tangible, intangible? Number three, will the organization consent to a related use? Maybe you're giving an asset that you want the charity to use, like art, for instance. Or are they going to turn around and immediately liquidate the asset? That factors into a lot of decisions on what types of charities that you donate assets to. And who is this charity? Are they a public charity, as we talked about earlier in our flow chart from the IRS? Or is this going to be a private 501c3? And do they meet the definition of a charitable organization under Internal Revenue Code 170? And that's for income tax purposes, and then 2055 for estate tax deduction purposes. And then finally, is the donor receiving something in return? Are they getting an income interest like they would from a CRT? Or are they getting some type of quid pro quo? So those are the factors that you want to look at really in analyzing any charitable gift out there. For those of you who sat through this that are Florida attorneys, this presentation is registered for CLE. And then for anyone nationally who's a certified financial planner, this is also qualified for CE. And here are their respected numbers. I'll leave this up here. You can pause it, obviously, to get these numbers. I mentioned earlier, one way to really efficiently produce these testamentary CRTs, where you are naming the CRT as the primary beneficiary of an IRA. Again, for most of your donors, they're not going to want to spend a lot of money on this on clients, so you really want to streamline it. Plan Giving Interactive is a good place to go, and that website is estategiftplanning.com. Of course, thank you for spending this hour with me. Again, Paul Casperson with the University of Florida, and I'm also the president of Plan Giving Interactive. And the best way to reach me is paul@estategiftplanning.com, or feel free to give me a call on my phone number anytime, 352-727-0454. Thank you for calling and have a great day.